뉴욕나우. 안녕하세요. 뉴욕나우 강영연 특파원입니다. 요즘 해외 주식 투자하시는 분들이 늘면서 ETF에 대한 관심도 커지고 있는데요. 오늘은 미국 ETF 운용사인 글로벌X의 루이스 베루가 CEO를 만나 관련 시장 이야기 들어보려고 합니다. 글로벌X는 빠르게 성장하고 시장의 주목을 받고 있는 미국 ETF 운용사인데요. 특히 기술 발전, 인구 구조 변화, 최근에는 블록체인까지 새로운 테마형 ETF를 잇따라 출시하고 있습니다. 현재 ETF 시장에 대한 진단에서부터 어떤 ETF가 유망한지 자세한 이야기 들어보도록 하겠습니다.
My name is Luiz Beruga. I'm the CEO of GlobalX ETFs, a proud member of the Mirai Asset Financial Group. Very glad to get to know the team from the Korea Economic Daily and have an opportunity to talk to all your readers in South Korea. And I look forward to a very, very productive conversation. Well, they have a lot of assets, so I mean, we're very optimistic. I mean, our view is like the industry, and I can give you a few data points. I mean, the industry is growing very, very fast, right? So right now, globally, there are over $9 trillion in assets under management. In the US, we just passed $6 trillion in assets. Europe, which is the second largest market in the world, they just passed, I think, $1.5 trillion in assets. But a couple of other data points is this year, both in the US and in Europe, through July, we've had more net inflows so far this year than in the entire 2020. And 2020 was the best year in history for the ETF industry. So almost halfway through the year, we've already passed the growth of the industry. Two times last year, right? So I do think it's really, really great. And what we are seeing also in the US is that ETFs are becoming the investment vehicle of choice for the large majority of investors. Historically, as you know, mutual funds were the main investment vehicle for the large majority of investors in the US, but we continue to see a transfer of assets from mutual funds into ETFs. I was looking at some data the other day. In 2000, ETF assets as a percentage of mutual fund assets were just 1%. In 2010, the number was 10%. And as of December of last year, it was 28%. So that adoption of ETFs versus mutual fund is definitely accelerating. And quite frankly, it will be difficult to reach BlackRock, but I do think obviously we are very well positioned within the ETF industry. So if the industry continues to grow at this pace, which I think quite frankly it definitely will, I think we're very well positioned to capture that growth. I mean, quite frankly, I think there are multiple reasons for that. As an investment vehicle, as a product, it's a much more efficient vehicle than mutual funds and any other investment vehicles. Why? Because you've got transparency. You can go to our website every single day. You can see the holdings of every single one of our ETFs. You've got liquidity. You can buy and sell your ETFs throughout the day in any stock exchange in the world. It could be NASDAQ, it could be the New York Stock Exchange, but you can buy and sell anytime throughout the day. They tend to have a lower management fee than mutual funds, and they are also more tax efficient because of the ability to manage the creation and redemption basket. And I think also that's purely from an structural standpoint. It's just a better product, in my opinion. But then there are also some trends taking place in the industry that also favor adoption of ETFs. One is financial education, so people know more now than they did before. Right now with your cell phone, you have access to all sorts of information, so it's a lot easier for people to buy and sell ETFs than ever before in history. Many of the brokerage houses in the US over the last couple of years, they're not charging commissions to their clients for trading ETFs. So if you take all of this into account, it's just not the quality of the product, but some of the more demographic and industry trends that are taking place. And this is a phenomenon that we are seeing not just in the US. I think the US is maybe a few years ahead with respect to other countries and regions. Yeah, I do think it's in the earlier stages. Like I said before, if you look at the growth, it just seems to be not going down. It actually seems to be accelerating. And you are seeing how other companies that have their own traditional mutual fund business, they're actually converting their mutual funds into ETFs. So there are two companies recently in the US. One is Dimensional Fund Advisors. They converted $30 billion worth of mutual fund assets into ETFs. And more recently, JP Morgan, they also converted, I think, two strategies worth $10 billion in assets to ETFs. So from my standpoint, I think we're still in the very earliest stages. There's another very important point that many people don't fully appreciate, which is why I think we're just in the earliest stages of the growth of the ETF industry, is that a large percentage of retirement assets in the 401k plan are within the 401k plans. 401k plans, because the way those plans were designed, they were designed with mutual funds in mind. So that their infrastructure, their record keeping, the pipes behind the scenes, the technology is all designed with the mutual fund wrapper in mind. But I do think that's going to change. More and more 401k providers are revamping their technology to be able to offer ETFs to their clients, because their clients are actually asking to be able to invest in ETFs within their 401k plans. So I think when that transition takes place, which it will take, it's not easy because, technology, it takes time, but over the next 5, 10, 15 years, I think a large majority of clients' retirement assets will be in ETFs, which will be like another very nice tailwind for the ETF industry. I think we've seen definitely thematic investing. I mean, thematic investing is an area of the ETF industry that has grown very, very quickly. I can give you a few data points because we do track thematic assets. If you take Q2 of 2020, they were roughly, around $42 billion in thematic assets. If you take the numbers of Q2, second quarter of 2021, the number is 143 billion. So that's a 246% growth in AUM in thematic investing strategies. So that is definitely a very significant growth for the industry, and I think right now is one of the most interesting areas of the market. Great question. I think it's structural, and I will tell you why. The economy has fundamentally changed over the last 2 decades, right? So you think about IBM in the 1990s. You think in the 1990s, you think of IBM as a very disruptive, high technology company. I don't think when you think of IBM today, and by the way, it's a great company. I'm not saying that they're not a good company, but I just don't think IBM means now in terms of disruption and high technology what it meant back in the 90s. So I do think the economy has evolved in such a way that investors need to have a much more granular way to invest in the companies that they want, right? Specifically, when you think about disruptive technologies, we have in our thematic suite, so I think we are right now at 30 thematic products. We typically divide our thematic products in disruptive technologies, people and demographics, and there's one more, but in any case, within the disruptive technology segment, we have cloud computing, robotics and artificial intelligence, fintech, blockchain. So there are many more companies that can be classified as technology. So the traditional view of the world where you have like a sector ETF just for technology, just for industrials, just for energy, I think it's obsolete. I think right now, because how much the economy has evolved, particularly around technology, investors need a much more granular way to invest in these disruptive technologies. And that's why I think this shift is structural and is not just a trend, because arguably there are right now many more companies that can be classified as technology than back in the 90s. Yeah, I mean, to be honest with you, In my opinion, and I think this about ETFs, but quite frankly, I think about this way for chairs, for a home, for shoes. Things are not expensive or cheap relative to what you get. So, for example, some people can argue that management fees or certain ETFs can be very high, but it's like, okay, what if you compare that number with mutual funds where you have many more fees somehow embedded in the overall cost of the mutual fund? So I would argue that relative to mutual funds and other investment vehicles, actually ETF is probably the most cost-effective way to access certain companies. And then, like I was saying before, it's a function of what you get for that management fee, right? Specifically in our case, and particularly around thematic ETFs, since it's what you mentioned, you get very well-designed products. We were the first company in the world to launch thematic ETFs, because right now everyone talks about thematic ETFs, but we launched our very first thematic ETF in 2010. It was our lithium and battery technology ETF that right now has close to $5 billion in AUM. We started to do thematic investing when no one was even talking about thematic investing. We didn't even call it thematic investing at that point. We just realized that our investors were looking for access to some of the most disruptive companies in the world. And on top of that, not only they are very well-designed products that tend to perform very, very well in the long run, but we also provide plenty of support to our investors when it comes to research, product development capabilities, conferences, webinars, all sorts of information. If you go to our website, you can download all sorts of information. We believe deeply in the benefits of transparency. One is infrastructure, the other one is energy transition, and the other one is the disruption of financial services. This disruption of financial services as we understand. Those are three areas where I do think the economy is going to change dramatically over the next 10, 15, 20 years. So if you look at infrastructure, two of our existing products that are a very effective way to play the transition that we are going to see in infrastructure development are PAVE, that's the ticker is PAVE, that's our GlobalX US Infrastructure Development ETF. As you know, with the government here in the US has approved like a $1.2 trillion infrastructure bill, and the whole idea is that if you look at railways, airports in the US, they are definitely not where they should be for the first economy in the world. So there's going to be a very significant infrastructure spending over the next 10, 15, 20 years. And we have a product that is designed specifically to capture that growth. That's in the context of infrastructure, or what I should call physical infrastructure. Then we also have digital infrastructure. We have a ETF, VPN, is our GlobalX data center reach and digital infrastructure, which is precisely designed to capture the growth of another trend that, in my opinion, is completely unstoppable. Everything is moving to the cloud, right? Back in the day, you go to your office, you have your computer there, the server is located in the back office there. Now everything is moving to the cloud, and that is going to require a lot more computing power and a lot more data storage. So we have an ETF designed specifically to capture the growth of all the needs of the companies when it comes to digital infrastructure. And by the way, digital infrastructure is also an element of the infrastructure bill that President Biden just signed very recently. So that's one of the buckets, infrastructure. Then the other one is the energy transition. If you think about electric vehicles, solar, wind, energy transition, how all governments around the world are heavily incentivizing companies to invest in clean energy, I do think it's going to take 5, 10, 15 years, but I think the snapshot of energy consumption, how the energy is delivered and consumed around the world 10, 15 years from now, it's going to be fundamentally different from what it is today. Finally, I do think the financial services industry, as we know it today, is about to be disrupted. If you think about very simple things, right? You want to send money back to South Korea, you have to go to the bank, do like a wire transfer that takes 3 days. They charge you $30 to do the wire transfer. Why, right? You have Vimo that you can send you money for the movies. So that, or the way, for example, trade execution and trade settlement in our industry, all that is going to change dramatically. I have absolutely no doubt. I mean, you can already see that, right? So when you go to Starbucks and then you're paying with your phone, and in my opinion, that trend is only going to accelerate. Every portfolio in the world needs either growth or income. So if you look at my portfolio right now, on the growth part of my portfolio, I have a lot of blockchain. I have a lot of VPN, the data center reach and digital infrastructure, lithium and battery technologies, and US infrastructure development. And then for the income part of my portfolio, which is a little bit more conservative, I have our cover call strategies, because in the current environment, that volatility and with everything going in the world, with tapering from the central bank or the Federal Reserve, with the volatility around COVID-19 and the Delta variant, we are going through like a very choppy market with a fair amount of volatility. Cover call strategies are strategies that tend to perform well in volatile environments, because the option writing, the premium that you get for writing those options actually goes up. So that volatility actually helps you. So if you have a long-term view because you're still young, or you're investing money, for example, for your children so they can have some savings, I do continue to think that thematic investing is a phenomenal long-term investment. The challenge with some of those products is that they tend to be very volatile in the short term. So you have to be ready to see your investment go down 2 or 3%, and don't worry too much, because you should be confident that over 10, 15, 20 years is going to be a phenomenal investment. So I have absolutely no doubt that will be the case. Some investors may not have a very long-term investment horizon. They may be much closer to retirement, and they probably should hedge their position a little bit, because if you are very close to retirement and the market drops very significantly, then their savings, their hard-earned savings for many, many years, can suffer significantly. So again, going back to some of our solutions on the income side, cover call strategies is a phenomenal way to deal with volatile environments, because actually your premium, the income that you get from your product, goes up in volatile markets. I think right now, so we may have similar themes, and I think both companies are definitely companies focused on disruption and innovation, but we do believe that for our thematic investing strategies, taking a more diversified passive approach is the most effective way for long-term investors to capture the outcomes that they desire. Right now, it is difficult to know. So that's one comment. And the other comment, our view when it comes to Bitcoin specifically, our view about Bitcoin is a little bit different from our typical thematic investing approach. So with our thematic products, we have a high degree of conviction that these themes, these companies, will perform very well over the long run. Because we've looked at the technology, we look at the addressable market size, the adoption of the technology, so we do know that over time, those companies will perform well. When we think about Bitcoin, to be honest with you, as a company, the fact that we apply to a Bitcoin ETF doesn't mean that we think Bitcoin is good as a long-term investment. We just want to give our clients access to the asset class that they are looking for. We do think I wouldn't put 20% of my portfolio in Bitcoin. It's a very volatile asset class, if you want to call it like an asset class. We do think there is a place for Bitcoin and digital assets in general in a client's portfolio, but I think it's very, very important that clients understand the risk involved with investing in Bitcoin. I do think there is my view is there is a space in the economy for cryptocurrencies. I do think it still has to overcome many regulatory constraints around the world, because at the end of the day, if you want cryptocurrencies to play the role of a currency in an economy, it needs to be quote unquote approved and regulated to some degree. There has to be more transparency that you have seen historically in cryptocurrencies. So there are still many things that need to happen from a regulatory standpoint before cryptocurrencies become more mainstream. My view is that over time, governments around the world will get more comfortable with the use of Bitcoin, and some other cryptocurrencies. But I do think at the end of the day there will be some consolidation in the interest of the markets, where you won't have 25 different cryptocurrencies. You will have 2-3 cryptocurrencies that become mainstream and will become widely accepted. But I do think that process might take a long time. My view with investing in general is that you should never try to time the market. It's very difficult to, if you try to time the market, you might get in trouble very, very easily. Because in situations like right now, people may think valuations are high, so you may choose not to invest in thematic ETFs, and then maybe the next 10 years are the best bull market in history. That could definitely happen. So by trying to get in and out of the market, you can miss out in very significant opportunities from a portfolio standpoint. So my view, if you have a long-term investment horizon, is you should stay in the market, and you should make regular contributions into the market. So from my standpoint, right now, I continue to buy as much as I can, and I continue to be invested. If the market continues to go up, I just continue to buy. And whenever there is a significant drop in the markets, like happened in March, April of last year, you just continue to buy. And for example, I think what happened last year, like literally, it seems like it was like 10 years ago, but it was literally 18 months ago. It seemed like the war was about to end, and many people were actually selling out. From my standpoint, that's where you want to continue to invest, and what I call a stay the course. No matter what happens in the markets, just continue to remain invested. Well, I mean, I do think, going back to the point of the investment horizon, right? Obviously, if you are in your 20s or 30s, your investment horizon is a lot longer, right? So in that particular case, I would make the argument for some of our thematic investing strategies. Right now, I have a high degree of conviction in, like I mentioned before, our blockchain ETF, our GlobalX lithium and battery technologies ETF. I do think when you think about the rise of electric vehicles, cell phones, all of our cell phones run on lithium batteries, there is a huge amount of demand for lithium, whereas supply is very difficult to produce because bringing lithium online takes several years, right? So I do think that's another long-term trend that is unstoppable in my opinion. So again, blockchain, lithium and battery technologies, and I would also cybersecurity. Cybersecurity is a theme that, because it's been around already for several years, people tend to not talk about cybersecurity as much anymore. But in my opinion, I just don't see a world in which there are less cybersecurity risks than today, because more and more things are coming online. Everything is through our cell phones, everything is digital. Right now, another ETF that we haven't talked about today, but I think it's actually a very interesting one, is Internet of Things, right? Which is basically you go home and then your fridge is connected to the internet, your TV is connected to the internet. That's great in terms of connectivity, but the more connectivity points that you have with the network, the more potential cybersecurity risks you are incurring. So from that standpoint, just where the world is going, I just see constantly more and more cybersecurity risk going on. I think people are much closer to retirement. I would take a more conservative approach. So I would offer a couple of ideas on the thematic investing space as well, because they still are growth-oriented themes, but by definition, they're a little bit more conservative or like more. One is our US infrastructure development ETF, because at the end of the day, you are investing in pretty large companies that are focused on the development of infrastructure in the US. And I think that is a trend that is going to take 2 or 3 decades. And those companies tend to be, the underlying companies in that product tend to be less volatile than some of the high-tech growth names. And then within the thematic investing space, I would also suggest our data center REITs and digital infrastructure, because there is an element of real estate there that makes that investment a little bit less volatile than our traditional thematic products. Then on the income side, I would, in this kind of environment, I would definitely encourage Korean investors to look at our covered call strategies because they tend to do well in volatile environments. And if they are very close to retirement and clients are concerned about the market being a bubble because you open the newspaper and there's always people that are saying, oh, the world is going to end tomorrow. If they are concerned about short-term volatility or the market dropping 20-25% before they retire, now we offer through our risk management suite of products, the products that we launched in the last couple of weeks, that could be like a very effective way to reduce tail risk within your portfolio. Obviously, with Chinese technology companies, I do think in the long term will continue to be like a really good play. But like anything else, the market does not like uncertainty. So when there are news that talk about some government intervention in how these companies are operating or whether or not a company is like it happened with the IPO that was supposed to go public and then it didn't go public. So I think that uncertainty is something the market typically doesn't like. In my opinion, the long-term prospects of China as an economy remain positive. So in some of these cases, like particularly China technology companies, they may have been oversold. And I do think there could actually be good entry points for investors that are trying to get back into the Chinese market. And Tesla, I do think it continues to be like a great company, a very innovative company. I do think it's a segment of the market that is evolving very, very quickly. So they obviously have a first mover advantage in the electric vehicles space. What is yet to be determined is whether or not some of the more traditional auto manufacturers will be able to catch up in terms of developing their electric vehicles fleet. But that's a really good example, in our opinion. The GlobalX approach to thematic investing is not so much about choosing if Tesla will be the winner within the electric vehicles space or if Mercedes or any other auto manufacturer will win the race. Our approach is different. Our approach is we do think electric vehicles, in the long run, will be a much more important part of the economy than they are today. And the penetration of electric vehicles in the world economy is going to increase by multiple orders of magnitude within the next 2 or 3 decades. So we try to provide access to our clients to these companies that are very well positioned within the electric vehicles space and not so much about whether or not this company will be the winner or the loser. And that's why I think our approach from a long-term standpoint is, in our opinion, more sustainable.
More exposure to the industry.
Exactly, to the industry. Because, you know, if you place very big bet in one company, whether it's Tesla or it's a different type of company, if for whatever reason the company does not perform well, and it could be for a number of different reasons, your portfolio can suffer significantly. But if you have a high degree of conviction, like we do, that electric vehicles will be a very significant part of the economy over the next 10, 15, 20 years, I just want to own the best electric vehicles companies in the world. And I don't worry too much about picking this one versus that one. And in our opinion, in the long run, that's a much more sustainable investment approach. So we use the market cap approach, but we call it modified market cap, which basically means, so we weight companies in the portfolio by their market cap. But there might be situations with companies that have been wildly successful, like Tesla or like Amazon or like Apple or like Google, that if you just use a straight market cap approach, you can be in a situation where like 3 companies are 70% of the portfolio. We don't want that. Going back to the point of diversification, we typically add a cap of between 8 and 10%. So no company can go beyond, it depends on the product, but roughly it's between 8 and 10%. That way we avoid that one company becomes a very large part of the portfolio. So we do see the benefit of the market cap approach because we end up owning more of the companies that do well, but also we want to be somehow careful that not one company becomes a very significant part of the portfolio.